If you own silver right now, you've probably seen the headlines: silver breakout, silver squeeze, silver about to explode. Some channels are calling for $40, $50, even $100 an ounce. Others are warning this is the top, that retail is late again, and that the whole move is about to unwind. If you're holding silver or thinking about it, that noise can be disorienting. Too bullish and you ignore risk. Too bearish and you miss opportunity. The goal today is neither excitement nor fear. It's clarity. This is Financial Briefing. On this channel, we don't chase headlines and we don't do clickbait. We slow things down, we look at the data, and we talk about probabilities, not certainties. By the end of this video, you'll know what actually matters for silver right now, what doesn't, and exactly how I'm thinking about positioning around it. Let's start with accountability, because context matters. Over the past year, we've made several calls on precious metals that weren't perfect, but they were grounded in data. Last August, when silver was trading just under $23, we said the downside risk was limited unless the 10-year yield pushed decisively, above 4.5%. That didn't happen, and silver based for nearly 3 months before beginning its move higher. That call wasn't about upside hype, it was about risk containment, and it held. In January, when silver broke above $26, we said the move was constructive but stretched in the short term, and that a pullback into the 24 to 25 range would be healthy. Silver pulled back to 24.70 before resuming higher. Again, not perfect timing, but the framework was correct. And more recently, in early April, when silver crossed $30 for the first time in years, we said something that made a lot of people uncomfortable. We said the move was real, but that volatility was going to increase, not decrease. That there would be sharp pullbacks along the way. Since then, we've seen multiple $1 to $2 intraday swings. That's exactly what happens when silver transitions from accumulation to speculation. So with that context, let's talk about what's actually driving silver right now, starting with the first data point. The most obvious number on everyone's screen is spot silver itself. As of this recording, silver is trading around $32 an ounce, up roughly 40% from the lows last year. That's a big move. Historically, moves of this size don't happen in isolation. If you go back 20 years, silver rallies of more than 30% over a 6 to 9-month window have usually occurred in one of three environments. Either real yields are falling sharply, the dollar is weakening meaningfully, or there's a supply-side shock layered on top of rising investment demand. Sometimes you get all three, sometimes you only get one. Right now we don't have all three. Real yields have come down modestly, but they're not collapsing. The 10-year TIPS yield is still positive. The dollar index has softened, but it's not in free fall. And while there are supply constraints in silver, especially in primary silver mines, there hasn't been a sudden acute disruption like we saw in other commodities during COVID. What this means is important. It means the silver rally we're seeing is driven less by panic and more by positioning and expectations. That's healthier than a pure fear trade, but it also means it's more sensitive to changes in macro data. What it does not mean is that silver is guaranteed to continue straight up. When silver rallies without a corresponding collapse in real yields or the dollar, it tends to move in waves rather than lines. Sharp advances followed by digestion, then continuation or failure. That brings us to the second data point: investment demand versus industrial demand. Roughly 55 to 60% of annual silver demand comes from industrial uses: solar panels, electronics, medical applications, and increasingly electric vehicles over the past 2 years. Industrial demand has been strong, particularly from solar. Global solar installations have continued to grow at a double-digit rate, and silver load per panel, while declining slowly due to efficiency gains, remains substantial. In 2023, industrial silver demand hit an all-time high, just over 600 million ounces. That's real demand. It's not speculative, and it's relatively price inelastic in the short term. Manufacturers don't stop making panels because silver goes from $25 to $30. At the same time, investment demand has been volatile. Physical bar and coin demand spiked during periods of stress, then cooled. ETF holdings of silver actually declined through much of last year, even as prices began to rise. That divergence matters. Historically, the strongest and most sustained silver bull markets happen when industrial demand is stable or rising, and investment demand accelerates at the same time. Right now, we have strong industrial demand, but investment demand is only just beginning to re-engage. That's constructive, but it's not confirmation. What this means is that silver has a fundamental floor that's higher than it was 5 years ago. Industrial demand is not going away. What it does not mean is that every investor on the sidelines has already rushed in. If that happens, prices could overshoot. If it doesn't, silver can stall even with solid fundamentals. The third data point is supply. And this is where a lot of the hype channels focus, often without nuance. Global silver mine production has been flat to slightly down over the past several years, hovering around 800 million ounces annually. Primary silver mines are rare. Most silver is produced as a byproduct of mining for copper, lead, zinc, and gold. That means silver supply doesn't respond quickly to silver prices. Even at $32, you don't suddenly get a wave of new silver supply. That's true, but it's also true that recycling supply increases as prices rise. Scrap silver from electronics, jewelry, and industrial waste becomes economical at higher prices. In 2011, when silver spiked near $50, recycling surged and helped cap the move. We're nowhere near that level yet. But it's a reminder that supply isn't fixed. What this means is that the long-term supply picture supports higher prices than the teens or low 20s. What it does not mean is that supply constraints alone justify exponential price targets in the near term. So, stepping back from the data, let's talk about what the bullish case actually looks like. Calmly, without hype. The first bullish argument is macro alignment. If inflation remains sticky while growth slows, real yields can drift lower even without aggressive rate cuts. That environment historically favors precious metals, and silver tends to outperform gold when investors move out the risk curve. Second, industrial demand continues to surprise to the upside. Solar installations accelerate faster than expected. EV adoption remains resilient, and silver demand grows faster than efficiency gains reduce usage per unit. Third, investment demand re-enters meaningfully. Not just retail buying coins, but institutions increasing exposure through ETFs and futures. That kind of demand can overwhelm short-term supply dynamics. And fourth, positioning. If large speculators remain underweight relative to historical peaks, there's room for additional buying without immediate overcrowding. Put together, that bullish scenario is plausible. It's not guaranteed, but it's real. I assign roughly a 25% probability to a sustained bullish breakout where silver holds above 30 and works toward the high 30s over the next 12 months. But we also need to talk about the bear case because silver has a history of humbling people who ignore it. The first bearish argument is macro resilience. If growth holds up better than expected and inflation cools faster, real yields could rise again. Silver does not like rising real yields. Second, the dollar could strengthen. If global growth weakens outside the US, capital flows back into dollar assets, pressuring commodities broadly. Third, speculative excess. Silver rallies often attract late momentum traders. If positioning becomes crowded quickly, small macro disappointments can trigger sharp sell-offs. And fourth, industrial demand sensitivity. While demand is strong, it's not immune. A global slowdown would hit electronics and solar installations, even if long-term trends remain intact. That bearish scenario doesn't require catastrophe. It just requires conditions to normalize. In that case, silver could easily retrace back into the mid-20s without breaking the long-term thesis. I put that probability around 30%, which brings us to what I think is the most likely outcome. The middle case is slower, choppier progress. Silver remains volatile, trades between roughly $28 and $36 over the next year, with sharp swings in both directions. It frustrates both bulls and bears. It rewards patience, not leverage. That's not exciting, but it's realistic. And I assign that scenario about a 45% probability. Before we go further, we need historical context, because silver's behavior rhymes even when it doesn't repeat. The closest analog to today is not 1980, and it's not 2011. It's the period from 2004 to 2006. Silver broke out from a long base, moved higher steadily, then entered a volatile range before its eventual blow-off years later. The similarity is a structural shift in demand alongside gradual investor recognition. The difference is leverage. In the mid-2000s, leverage was building systemically. Today, leverage exists, but it's more regulated and more fragmented. That reduces tail risk on both sides. It makes a sudden collapse less likely, but it also makes an immediate moonshot less likely. Now let's zoom out and look across markets because silver doesn't trade in a vacuum. Gold is holding near all-time highs, trading around $2,300. That's supportive. Silver rarely collapses when gold is strong. The dollar index is hovering around 103. That's neutral. A break below 101 would be bullish for silver. A move above 105 would be a headwind. The 10-year yield is around 4.3%. That's the pivot. Sustained moves. Lower help silver. Sustained moves higher hurt it. Taken together, cross-market signals are mixed but not hostile. Positioning tells a similar story. Commitment of traders data shows managed money net long silver, but not at extremes. Banks remain net short, as they usually are, but not aggressively so. That suggests the trade is not yet overcrowded. So what am I actually doing? My current allocation to silver, across physical and paper, is about 8% of my total portfolio. That's up from 5% last year. If silver pulls back toward 28 without a macro deterioration, I would add incrementally. If silver spikes above 37 quickly, I would trim. My stop loss on paper positions sits around 26. Below that, the thesis changes. My take profit zone for trimming begins around 38 to 40, depending on momentum. Not advice, just my framework. What I'm not doing is panic buying. I'm not watching fear-driven content telling me the system is collapsing tomorrow. And I'm not assuming silver has to do anything. This week, I'm watching 3 things. First, CPI data. A downside surprise helps silver. An upside surprise hurts it. Second, the dollar index. A break below 101 is bullish. Above 105 is bearish. Third, ETF flows. Sustained inflows would confirm investment demand. Outflows would signal hesitation. So to wrap this up, here's what matters. Silver's move is real, but not guaranteed. The fundamentals are supportive, but not explosive. Volatility is a feature, not a bug. And discipline matters more than conviction. If this kind of calm, data-driven analysis helps you think more clearly, subscribe to Financial Briefing. That's what we do here. Stay sharp.